Money, Game Master, 7 Simple Steps to Financial Freedom, author Tony Robbins. Subtitles by Free Book Summary. Introduction. The mission of this book is to help you make informed money management decisions that can lead you to financial independence. Large financial institutions exist to make profits for themselves, not for their clients. Therefore, relying on their advice is not always profitable and often simply unsafe. 9 myths that Tony Robbins debunked are just about that. Tony's mission is to introduce people to the most honest practical financial solutions, some of which are still considered secret. Realizing that people need not only knowledge, but also an understandable roadmap to a financially secure future, Robbins tried to present it in the form of simple 7 steps. The strategies and recommendations in the book are the result of unprecedented research and the author's access to the best minds in the world of money. Richard Branson, Warren Buffett, Charles Schwab, and that's just a small fraction of the big names. But Tony, with his enthusiasm, connections, and ability to persuade, managed to get unique information from them based on the knowledge and experience of the winners. Now the secrets of professional investors are available to you. All that remains is to decide to take responsibility for your money. Step 1. Make a conscious decision to become an investor. Along with religion, sex, or politics, money is also a taboo topic at the dinner table and sometimes in the workplace. Having money makes people feel guilty, and not having money makes people feel ashamed. At its core, money is power. We know that money can help a dream come true, or it can start a war. But all of this is, by and large, an illusion. In the end, it's not the money itself that we care about, but the emotions and feelings that money can provide us: influence, security, the ability to help those we love and those in trouble. How you handle money reflects how you handle power. Is it a game or a burden for you? Play is a strange word to apply to a topic as serious as money. But this book is precisely about the fact that the best way to improve your finances is to find people who have already done it and then copy their pattern of behavior. That is, play. Numerous interviews with the richest people in the world prove that most of them treat money like a game. Why else would they continue working 12 hours a day, and they already have billions of dollars in their accounts? But it's a game you can't lose at. However, if you follow the 7 simple steps outlined in this book, you will win the game, and you will win big. To do that, you need to know the rules of the game and learn the best strategies. This book will give you the necessary knowledge. Why does an ordinary person need this knowledge? Let's look at it another way. Can you afford to remain a common person? Here's what the statistics tell us. Now in the US, 50% of married couples live to be 92 years old. That means that after retirement, a person lives about 30 more years. And there is no reason to expect that you can finance your 30 years of retirement with savings from 30 years of work. According to Ernst & Young, 75% of Americans will run out of assets before they die. Meanwhile, the U.S. Social Security system only covers basic needs and cannot provide you with a decent lifestyle. 48% of working Americans have never thought about how much money it will need for retirement. Step to become an insider: learn the rules of the game. According to David Swenson, author of Unprecedented Success, manager of Yale University's $23.9 billion endowment university investment fund and one of the most successful institutional investors of our time. To achieve unprecedented success, you must be guided by unprecedented wisdom. To do so, let's debunk 9 financial myths that can take you in the wrong direction and reveal the new rules of money that will make you financially independent. Myth 1: the $13,000 lie. Invest with us. We'll outperform the market. The stock markets have been the best place to invest for the last 100 years. It usually goes like this: we put our money into a 5-star, well-managed mutual fund in the hope that the fund will outperform the market. The truth is that 96% of such funds do not outperform the market. When they say outperform the market, they are referring to a stock index made up of a set of stocks. It is a list of 500 companies, a market value, in the US selected by Standard & Poor's. We are talking about companies such as Apple, Exxon, and Amazon. By investing in the index, you don't have to pay professionals to pick stocks. The Standard & Poor's or Dow Jones agencies have already picked them for you. There are 707 mutual funds in the US today that help you play the market. From December 1993 through December 2013, the S&P yielded a 9.28% annualized return, while investors receive 2.5%. The difference was made because we buy high and sell cheap, giving into emotion and constantly moving from one fund to another. Jack Bogle, founder of Vanguard, suggested another option: passive investing, the principles of which are maximum diversification, minimum expenses, and maximum tax optimization. Another problem with investing is not knowing the exact amount you are paying for brokerage services. Myth to the cost of our services. Yes, you have to pay a little. People are most annoyed when they have to pay more than they bargained for, whether it's buying a car or paying for a hotel room. But this is especially common in the mutual fund industry. The average cost of participating in such funds is 3.17% per year. In this case, you invest your capital, take the risks, and these funds make money off you, regardless of the outcome. These are the services you have to pay for: expense analysis, transaction costs, taxes, brokerage fees, which are covered by total commissions, investment allocation fees, exchange fee, account maintenance, payment for purchase, payment to sell immediate or deferred swap expensive mutual funds for funds where you'll pay a maximum of 1.25% per year, such as Vanguard. Myth 3: what will you get in the end? You will get what you were promised. The average return that mutual funds advertise to you is similar to your profile picture on a dating site. It usually looks better than the reality. Myth 4: I'm your broker and I'm here to help you. When a mutual fund broker tells you that he is acting in your best interest, he truly believes it. He's not aware of what you've learned about in previous policies. He may even be using a similar scheme for his own finances as well. The way the incentive system works is that the broker is rewarded for making sales, not for providing you with expert advice. Legally speaking, the broker is offering you a suitable solution, but suitable is not always the best. Being among other mutual fund investors gives you the social comfort of knowing you're not alone, and you continue to invest on autopilot that way. As for senior managers, 49% of them do not own shares in the mutual funds they manage. Moreover, according to an anonymously conducted survey Financial Planning Association, 2013, half of practicing brokers do not use the vehicles they offer to clients for themselves. Today, there are alternatives and automated resources on the market that you can use to make your own decisions about how and where to invest. www.strongholdfinancial.com. In a matter of seconds, the system will aggregate everything you own: stocks, bonds, mutual funds, etc. Will show you how much you are paying for services and how much less your pension will be. If you don't minimize these expenses, calculate your risks, offer you an alternative portfolio of investments, shows you your situation from a tax perspective, and suggests the best solution. If you are ready to move forward, the system will transfer your accounts to one of the recommended third-party custodians such as TD Ameritrade, Fidelity, Schwab, and will automatically manage your accounts if your investments are over $1 million. The Private Wealth Division is at your service with access to the highest yielding instruments. Myth 5: your retirement isn't far away. Even if you choose a retirement plan and carefully follow all the arrangements, it doesn't guarantee you a decent pension. Let's trace this back to the 401k popular retirement plan in the US, the most popular retirement plan in the States. To start with a little bit of history, the 401k system, introduced in 1984, gave everyone the opportunity to participate in the stock market or join American capitalism, but by contributing 3% of your income for 30 years, you can't expect to live the remaining 30 years of your retirement with an income comparable to what you had when you were working. Nor should we forget that this social experiment is only a few decades old. We are just beginning to see the generation that plans to live in a 401k system. As you know, most mutual funds don't perform well in the marketplace, and most 401k plans place their funds there. Mutual funds charge a disproportionate fee for managing your investments, making your benefit unobvious. Myth 6: trust funds, do it once and forget about it forever. So-called TDS funds work on the following principle: choose the date, year in which you retire, and we will manage your investment portfolio accordingly. With each approaching retirement year, the portfolio will become more conservative, favoring bonds, which are considered less risky. It's simple: decide on a date and forget about it. TDF's funds have their pros and cons. Anyone planning to invest should learn the skill of income distribution or utilize the resource www.strongholdfinancial.com Myth 7. I hate annuities. Funds placed in a special fund with regular dividends, and you should too. In reality, it all depends on what annuities you own and your insurance company's rates. When the author interviewed experts on this topic, David Babbel's name kept coming up as a key expert on the subject. His point was that there are annuities you should hate, but to exclude all annuities is to discriminate against a time-tested financial tool. Caesar used this scheme. European nations use the annuity concept. It is essentially a direct contract between you and the insurance company. You give them your money and they promise you a guaranteed return or refund. Once you have contributed your money, you need to decide when you want to start receiving your income. The longer you wait, the higher the income. We suggest using the annuity experts at www.lifetimeincome.com, where you will learn the pros and cons of your current annuities, decide on service charges, and finally decide whether to keep your existing annuities or exchange them for other annuities. Myth 8. You'll have to take bigger risks to get bigger returns. Friend of the author, Richard Branson, owner of the Virgin Empire, founded Virgin Airways in 1984, intending to overtake his competitors, including British Airways. Despite such ambitions, his biggest concern was how to avoid risks, and he managed to negotiate the deal of the century. Branson would buy his first planes, on the condition that if the business project failed, he would take them back. However, in the investment market, you will always be told, either explicitly or implicitly, that in order to win big, you must take big risks. This is not true. Millionaires like Richard Branson and Warren Buffett will tell you differently. Minimize the risks and win big. Below are 3 proven strategies. 1. Structured securities notes. You lend money to a bank, usually the largest banks in the world. In return for the money, the bank gives you notes. After a period term, the bank guarantees you 100% of your deposit if the market goes down, or a certain percentage of the market's profit plus your deposit if the market goes up. 2. Certified market-linked CDs. This option is similar to the previous one, but also includes insurance from the Federal Deposit Insurance Corporation (FDIC). 3. Fixed index annuity. This option gives you 100% protection from the insurance company and allows you to win when the market goes up and be protected when the market goes down. Myth 9. Lies we tell ourselves. The last myth left to deal with is that we can't succeed because we don't have everything in our power. But that's just a limitation of our perception. We all have a fear of failure, and we tend to explain our failures with stories, and the reason for failure is always beyond our control. But to achieve financial freedom, you need to make a breakthrough. In order to make a breakthrough, you need 3 elements. You need to change your strategy, change your story, and change your state. Step 3. Decide what percentage of your income you will invest and where. A strategy that can realize your dreams. If you ask people how much money they need for financial freedom, they will start to name unrealistically large amounts, and their subconscious mind will start rejecting this possibility. The more realistic the goals you set, the faster you will succeed. And remember, life is not about money, it's about emotions. The real goal is to have the lifestyle you want. The next thing you need to know is where you should start on your financial journey and how much money you will need to achieve your goal. You can use the resource Tony Robbins, Master the Game to calculate this. After familiarizing yourself with the 5 financial dream options, you'll choose 3 that particularly inspire you. Dream 1. Financial security discovers your basic expenses. Dream 2. Financial liveliness, basic expenses plus reasonable enjoyable spending. Dream 3. Financial independence, now you don't have to work. Dream 4. Financial freedom, you don't have to work and can afford luxuries. Dream 5. Absolute financial freedom, the concept speaks for itself. Now that you've chosen your 3 options for yourself, wake up your desire and focus. Next, start being proactive and effective. And finally, trust luck, proven strategies, yourself. At the same time, you must create the kind of financial plan that is right for you. This is not a race or the Olympics. You should not be guided by others. At www.tonyrobbins.com. Master the Game, you will be asked to answer a few questions. Based on your answers, the app will create a plan that is right for you. There are several strategies for realizing your financial dreams. Strategy 1. Accelerate. Save more and invest the difference. You might consider paying off your home loan faster, saving on bank interest, or not buying the most expensive car. David Bach, friend and partner of the book's author, has conducted seminars for for 1 million people around the world and published the book Automatic Millionaire, The Powerful One-Step Plan for a Rich Life. The resource upromise.com will teach you how to save money every day. Finally, do the following exercise. 1. Brainstorm your expenses. What expenses can you eliminate or reduce? 2. Estimate the magnitude and frequency of these expenses. 3. Rate these expenses on a scale of 0 to 10, how much you enjoy them. 4. Recall the question, what is the price of your financial freedom? Might you be willing to give up some of your current expenses to achieve your goal? 5. Decide for yourself what is more important to you. 6. Write down at least 3 items of spending that you are willing to give up. Strategy 2. Earn more and invest the difference. When Tony Robbins was a child living in poverty, his mother dreamed of him becoming a truck driver and working his way out of poverty. But living in Los Angeles and seeing affluent families around him, Tony couldn't accept it and wanted more. As a teenager, Tony met a man named Jim Hanna who changed his life. He told him about a seminar by Jim Rohn, who later became Tony's first mentor. One of the valuable pieces of advice Tony received was this: the only thing you have to do to make more money is to become more valuable in the labor market. According to Warren Buffett, the most valuable investment he has made in his life is an investment in himself. This is the best strategy for your financial freedom. Look for new trends and new opportunities. Like Sarah Blakely, who owns the Spanx brand and is now named one of the 100 most influential people in the world. She was the earliest to find the niche of compression underwear manufacturing, and Sarah took it over. Strategy 3. Cut your payouts and taxes and invest the difference. The average American spends half of their income on various taxes. Research this issue, review your taxes, and optimize them. Strategy 4. Get a higher return on investment. This is about investing in high-yield investments. Since Tony grew up in Southern California, he was always attracted to real estate investing, specifically building prestigious nursing homes with quality care. Another way is to diversify your investment portfolio. Strategy 5. Accelerate. Change your life, your lifestyle, for the better. Why don't you consider an option such as moving to another city if it will save you money? For example, you could move from San Francisco to San Diego and save more than 30% on housing costs. Such a move would allow you to start the economic freedom machine at unprecedented speed. Tony Robbins, 2, recently decided to change his residence because of cost-saving considerations. When his taxes in Southern California reached 68%, he moved to Florida, where the tax regime is more democratic. If you're thinking about relocating, check out the resource moneyuse.com to find out where you can live for as little as $75 a day. Some states have no income tax at all: Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. Step 4. Make the most important investment decision of your life: a robust asset portfolio. Asset allocation is the most important decision of your life. There are 3 tools that lower risk and increase return. 1. Selecting reliable stocks. 2. The right time to invest. 3. Diversification of assets. Don't put all your eggs in one basket. This principle comes in handy when you are making investment decisions. There are 8 types of investment options. 1. Cash. 2. Bonds, corporate, municipal, etc. 3. Certificates of deposit, CDS. 4. Real estate. 5. Pension. 6. Annuity. 7. Life insurance. 8. Structured securities. If you think you can predict the market, you are wrong. According to Benjamin Graham, the guru of modern investing, in addition to diversifying your portfolio, you should diversify your investments over time. If you create a timeline of investments over time, you will increase your chances of a high return on investment. When making this decision, you should consider at least 3 factors: the stage of life you are in, depending on how much time you have ahead of you to realize your financial dreams, as well as to make potential mistakes in the investment field. You may make a decision one way or the other. Your psychological risk tolerance. This is a highly individualized position depending on your temperament, life experience, etc. Consider your tolerance when allocating assets, your available liquidity. If you earn a lot, you can afford more potential wrong moves than those who are barely making ends meet. Although of course no one likes to lose. When you factor in these positions, market volatility over time will become your friend. Step 5. Only pros, no cons. Create a lifetime income plan. Ray Dalio was most impressed by the 1971 announcement by the US president that the dollar was no longer tied to the value of gold. The market now determined the value of the dollar. Since then, Ray has always been ready for surprises. He has researched all sorts of factors and uncovered all sorts of unknowns in making investments. In 1991, he launched his product portfolio of investments Alpha Strategy, which now has $80 billion and returns 21%. His other strategy for all weather became available in 1996. He believes that only 4 factors affect asset values: 1. Inflation to deflation, 3. Growth in the economy for a falling economy. With this in mind, he developed his new for all seasons version of his investment portfolio. In recent years, we have experienced significant changes in the economy, crises, and this has more than once led to investment decisions being emotional rather than well thought out. The for all seasons strategy protects not only from the environment, but also from ourselves. Stronghold www. Stronghold Financial.com utilizes this strategy for its clients. At www. Economic Principles.org you will find a video of Ray Dalio explaining the origins of this approach. In early 2014, the Guinness Book of World Records reported on the purchase of $201 million worth of life insurance. Such expensive insurance is bought not only by millionaires, but also by large corporations such as Walmart and Wells Fargo. The point is that this is how they avoid taxes. Since the capitalization of the investment is not taxed, TPLI insurance, private life insurance, works in a similar way. This insurance is used by doctors, lawyers, business owners, etc. Its advantages are as follows: unlimited deposits, no limit on income, no taxes on investment growth, no taxes on access to investments if properly structured. At TIA-CREF.org. Public, you can get information about this insurance and buy it yourself. Another option to protect your family is a living trust, a legal document that records your will regarding your assets during your lifetime, similar to a will. Unlike a will, with a trust you can protect your family during your lifetime. Familiarize yourself with the following resource. Get your shittiger.org. Step 6. Learn from professional investors. The people listed below shared their secrets with Tony, which became the foundation of the book. But the opportunity to learn from them and other professional investors remains beyond. Read and listen thoughtfully to everything they share in speeches and articles. Carl Icahn. When Carl Icahn said in 2013 that Apple was undervalued and that he was going to buy its stock, Apple's stock jumped 19 points. 4 months later, Times Magazine put Icahn's photo on the cover and called him the ruler of the universe. Carl Icahn has made more money than Warren Buffett over the past decades. This is a man who not only looks for business opportunities, but creates them himself. Carl comes from a simple New York family, his mother a teacher, his father a failed singer. He himself played poker to earn money to attend Princeton University. David Swensen. David Swensen may be the most famous investor you've never heard of. At his core, Swensen is an inventor and innovator. His Yale model, known as the endowment funds model, was developed with his colleague and former student Dean Takahashi. The idea is to divide a portfolio into 5 to 6 equal parts and invest them in different asset classes. Before Yale, Swensen worked on Wall Street at Salomon Brothers and was involved in a deal between IBM and World's Bank. John Jack Bogle. John is the creator of Index Fund and founder and former CEO of Vanguard Group. Fortune magazine named Bogle one of the 4 investment giants of the 20th century. He has been compared to Benjamin Franklin for his ingenuity and civic spirit. Vanguard is the world's largest mutual fund manager with $2.86 trillion in assets. Jack was born in 1929 on the eve of the Great Depression. His family was not wealthy, but he received a scholarship to Princeton University and worked part-time as a food delivery boy. It was there that Bogle began writing his thesis on mutual funds. After graduation, he joined Wellington Management Company, where he rose to the position president and then founded his own company. Warren Buffett. He comes at number 3 on the list of the richest people in the world. A regular broker from Nebraska who managed to turn a dying textile company Berkshire Hathaway into the world's 5th largest company with $500 billion in assets and owning major brands like Geico Insurance. He has not only become one of the most successful businessmen in the world, but also the largest philanthropist. directing 99% of his personal income to charity through the Bill and Melinda Gates Foundation. Paul Tudor Jones. Paul is the founder of Tudor Investment Corporation and founder of the Robin Hood Foundation. One of the luckiest traders of all time, Paul started his company when he was 26 years old. He became a legend when he predicted Black Monday in 1987. His foundation sent $1.45 billion to New York City programs to fight poverty. As a macro trader, he researched how psychology, technical analysis, world events and other factors affect asset values. Mary Callahan Nerdos. Mary is an executive director of J.P. Morgan Asset Management Division, a rare female comet in the male-dominated sky of Wall Street, Forbes magazine says of Mary, mentioning her in its list of the 100 most powerful women in the world. To date, Erdos manages $2.5 trillion investments. Money management is in Erdos's blood. Her father was an investment banker. She graduated from Georgetown University and continued her education at Harvard. Boone Pickens. Boone is the chairman and CEO of BP Capital Management. He has always been ahead of his time. He had to start from scratch. At the age of 12, he was delivering newspapers. After graduating from the University of Oklahoma, Pickens built an energy empire in Texas. In 1981, his Mesa Petroleum Corporation became one of the largest independent oil companies in the world. Kyle Bass. Kyle is the founder of Heyman Capital Management. Kyle and his family live in Dallas and consider it an advantage to live away from New York City. He sits on the University of Texas Investment Management Co. Board of Trustees, helping to manage the largest endowment, $26 billion in size in the country. Mark Faber. Mark is a principal of Mark Faber Limited, publisher of the Gloom Report, Boom and Doom, an investment analysis magazine. Like John Templeton, he hunts for the kind of deals that others avoid. Asia is the one region where Mark invests almost exclusively. He earned the nickname Doom by constantly predicting that major U.S. assets were overvalued and would collapse, and he was often right, particularly in 1987, when the U.S. stock market collapsed and Faber made a lot of money. Mark earned a doctorate in economics from the University of Zurich and began his financial career at the investment firm White Weld & Company. He moved to Asia in 1973 and manages his assets from offices in Hong Kong and Thailand. Charles Schwab. Charles is the founder of Charles Schwab Corporation. A style of personal involvement and openness has distinguished Charles Schwab for 40 years and has helped build a financial empire with $2.38 trillion in client assets. Sir John Templeton. John is the founder of Templeton Mutual Funds, philanthropist and creator of the Templeton £1 Million Prize. Sir John Templeton is not only the greatest money manager, but also one of the greatest men who ever lived. He is one of Tony Robbins' mentors. Coming from a simple family, he wasn't always Sir. After graduating from Yale and Oxford in 1937, he got his first job on Wall Street. In 1972, he established the world's largest annual spirituality award, with Mother Teresa among its recipients. Step 7. Just do it, enjoy it, and share it with others. We are used to thinking that money won't make us happy. Recent research shows that money can make us happier, but not the money itself, but how we choose to spend it, as freedom of choice has positive biological and emotional effects. To book Happy Money: The Science of Smart Spending by Elizabeth Dunn and Michael Norton talks about ways to spend money that will make you happy. 1. Invest in experiences, traveling, learning. 2. Buying time for yourself. 3. Investing in others. If you have any limitations to getting into action, they are in your head. Don't let stereotypes and complexes dictate how you live your life. Therefore, just get started without putting it off. Conclusion: this book is about how the best way to improve your finances is to find people who have already done it and then copy their pattern of behavior. To do this, you need to know the rules of the game and learn the best strategies. This book will give you the knowledge you need. First, find a way to do something for people better than others do. Become indispensable. Do more. Give more. Provide better service. And you'll have the ability to earn more. And it doesn't matter if you're providing fast food services in Texas or if you're the founder of Instagram. However, you should be able to not only earn more, but also multiply what you have. And to do that, you need to go from being a consumer of the economy to an owner of the economy. And you can do this by becoming an investor. From several variants of the financial dream, Everyone can choose the one that particularly inspires him. There are 5 proven strategies for realizing the financial dream. Strategy 1. Save more and invest the difference. Strategy 2. Earn more and invest the difference. Strategy 3. Cut your paychecks and taxes and invest the difference. Strategy 4. Get a higher return on investment and accelerate your path to victory. Strategy 5. Change your life, your lifestyle, for the better. Implementing the strategy requires knowledge of the tools, such as choosing investment options, which include cash, bonds, certificates of deposit, real estate, retirement, annuities, life insurance, and securities. The secret to proper asset allocation lies in maximizing diversification, choosing reliable stocks, and timing your investments. The world of investment decisions is shrouded in myths and legends. Myths such as the small fees charged by large investment funds, the need to take big risks in the expectation of big dividends can be confusing. But knowing how things really are, you will always be able to make the right decision. Again, make sure you memorize the 7 steps to financial freedom. 1. Make the decision to become an investor. 2. Learn the rules of the game. 3. Decide what percentage of your income you will invest and where. 4. Create a robust portfolio. 5. Create a lifetime income plan. 6. Learn from professional investors. 7. Just do it. Thank you all for listening to the end. If you liked it, don't forget to rate and subscribe to the channel. You can buy the full version of the book at the link in the description.